Okay, hello everyone. Mike Wisniewski with Materials Exchange. It is January 2nd? Third. Oh my gosh. January 3rd. I apologize. That's right. We had off yesterday. It's Tuesday. Uh, Greg Kuda is trying to get back from Florida. Evidently, he is having some traveling issues. So it is just going to be me today. Um, we'll do an abridged version of the show. Because Greg normally puts together the nice presentation that we have. But I have put together quite a bit of the information that Greg normally brings together. I'm just going to give it a minute or two here for some more people to roll in. I know our email went out a little later than we had anticipated, um, but we are basically ready to go. Um, oh, you know what? I had a page up here that I wanted to show, and I think I covered it up. So that is what I will do first here is get the couple of pages that I wanted to have. All right, open this guy up. So for the first thing I'm going to show here actually is a different screen. Okay, so this is from Globe Street, actually. The website is globest.com. I highly recommend checking these guys out. They do everything real estate, commercial, residential. Um, but I saw this article and it kind of struck a chord with me. And the first thing is, what a difference a week makes when it comes to 30-year fixed, which rose for the first time since mid-November, hitting 6.42 for the week ending December 29th. I think everyone's getting pretty used to that six handle on the mortgage rates. But what was really interesting to me was a year ago, the 30-year was averaging 3.11. So yeah, obviously up little over 3%. Um, and then but the Mortgage Bankers Association said there was a slight improvement from affordability in November. All right, interest rates go up, but affordability goes down. Or, I'm sorry, affordability improves. How is that possible? Well, home prices are going down. Well, the median purchase price um, how does this it increased? It's down more than 40 from the peak that it hit, but evidently the affordability got slightly better. Good news. So then let's just jump over to some statistics. U.S. housing starts. Permits fall on the slide in single family. So interesting thing in here. So residential starts decreased to 1.43. The big drop was really in the single family home building. And here's the chart on that. And you can see since essentially March, those numbers have really started to tail off. We went from 1.2 million on single family down to we're about 828,000 on an annualized basis. But what I think was really interesting, builder sentiment has continued to fallen every month this year. That's not a surprise. Um, Meanwhile, the number of homes completed jumped nearly 11% to an annualized 1.49 million. What I find interesting about this, we're completing these houses, lumber prices are still going lower. So that tells me that we are in a massive inventory liquidation. We're still building, we're still putting these houses up, but lumber prices have been going down. So the lumber prices rose all the way into the spring of this year, which was in build of lumber inventories at the distribution level. Now we're completing more houses, yet prices have fallen. So that tells me that we're not building inventories. We are liquidating the inventories in the field, liquidating the inventories in our yards and in our distribution centers. And then the last one I was going to look at. Well, we'll skip that. Now we're gonna go back to the presentation now. All right, share the screen. All right. U.S. home sales post record 10th straight month of declines. So existing home sales fell 7.7% as the Fed keeps raising interest rates, which makes sense. The existing home sellers are not as pressured to sell their home as a new home seller. So if you are a developer or a builder and you have inventory on the books, you're motivated to sell. If you are someone who is in a house, probably with a inexpensive mortgage, if you put your mortgage on, or if you bought your house and had your mortgage anytime in the last prior 5 years, you're probably looking at a 3% or less mortgage. This was the one I already showed. Mortgage rates continue to rise. All right, so now let's get into the data. Open interest. The January lumber futures contract, of course, is in the expiration month, which means there is no limit on that contract. It can trade all around. And as you would expect, the open interest, which is shown right here, 438 as of last Friday, has decreased significantly. I think that's a pretty reasonable number to, in fact, maybe even just a little lower than I would have expected. But we've got, we get trading till the 15th, so about 2 more weeks of trading in that contract. Overall open interest is 3,000, up just a little bit. A pretty solid open interest from recent times. And the majority of that open interest is in the March contract, of course. Now, one unique thing you're seeing here is there's only 3 contracts being listed. As of May, the legacy contract, the railroad car contract, will go away, and we will be all on the new contract, which is truckload delivered Chicago, which is shown actually below here. These are options on the new contract. And something I just wanted to point out, why were there so many options exercises on the previous trading day on Friday? Option expiration happened on Friday. So if you have an option that is in the money, it will get exercised. The close, it doesn't show. It doesn't show here. But evidently the close of January futures, I'm sorry, I can look up here, was $496.50. So the 490 puts were in the money. The 500 calls were in the money. They automatically, 500 puts and the 490 calls, both in the money. They will automatically get exercised. So one thing you will notice, there's probably a little jump in open interest because these contracts were exercised. So we'll go look at the next. Open interest fell. Look at that. This is the new contract. So January, we had at the close an open interest of 69. But the March and May here, 194, 101. Total open interest at the close was 377. Total volume 38. So it's starting to pick up a little bit of momentum, which is good to see. This is a statistic that Greg and I have been talking about ad nauseum since last summer, and it is the managed money are the shorts in the market. They have sold this contract, and they can continue to sell the contract. Their interest went up another 42. I think, when we look at the charts, you're going to see there was a bump up in price. And whenever we see the prices going up, it tends to add the industry adds a little bit of shorts, and the managed money keeps adding shorts. What I really find interesting is this number of 1847. It makes up almost 60% of the open interest. That's basically 2 out of every 3 shorts are held by a fund or by managed money. What we know is that these contracts continually need to be rolled into the next expiration. Right now, that's about 2 months out when we'll see this rolling. So we'll see this happen starting in late February and moving into the end of February. Okay, that is it for that part of the presentation. What I want to show now, I just want to look at some charts. All right, so let's see. How can I make this? Is barchart.com, and what we have here. Oh, I'm sorry. I gotta share it. Okay, barchart.com, an excellent resource for free charting. This is a 20-year monthly nearby, and if we go to put the line right around 370 where we're at. Oops. You can see from a historical standpoint, we're not outrageous. We're at the higher end of the historical spectrum, starting in dating all the way back to 2017, but not outrageous. And what I find really interesting, when I looked at this chart, I went at the lowest point in the last 20 years was January of 2009. So if we all remember back then, it was the financial crisis. In fact, the financial crisis really was the tipping point where the housing market had become so overvalued, and there was a ton of really bad loans in the system, and Lehman Brothers collapsed. It was a bad time, but lumber happened to bottom out right at probably the pinnacle of all of the bad news coming out. So if you fast forward to today, we've obviously come off significantly since the Fed started raising interest rates, which here you can look, this is March of 2022. And this is the old buy the rumor, sell the fact idea, which is essentially saying the news is already in the market. And you could see that. Let me bring this chart up a little closer. We'll go to, here's a 10-year chart. And I think that takes us back to 2014, 2013. And in fact, if you look at that chart, we're at points that are quite a bit lower than historically. We look at the 5-year, obviously in the last 5 years, we are at a point where most of the time in the last 5 years, we've spent above this price point. All right, let's bring this right up to speed here. I'm going to do a daily nearby. So this is front month daily, and obviously whoever sold on March 4th is deep in the money on these. And what we know is that's what the financial markets were looking at. That's what the money market, the commodity funds who are short this market, I'm guessing they've been selling this whole time. So you've got the high of this chart here on March the 4th. We've got the low occurring a little over a week ago on December 20th. I want to change this. Here's the really cool thing about this chart program here on Bar Chart is you can change these charts. I'm going to do candlestick open to close. I really like candlestick charts. Not much to see here other than we are absolutely in a downtrend. What I'm looking for right now is this low, which the low is 362.20. That's the downside target right now. And if we don't take out that low, then we have not continued the trend. I'm not going to say we've broken the trend yet. To break the trend, I would say we don't take out the 362, and then the next target would be the high here on the 28th, which was 404. So you got about a $40 range. It would not surprise me for us to stay inside of that range for a little bit. But right now, if you're a technician, your target is this 362.20. On a failure to meet that, you turn around and you look at the upside target of 404. Let's just say we failure to meet that, then it's a sideways market, which we've had years in the past where we've trended sideways in ranges tighter than $40. So that essentially wraps up what I wanted to cover today. Greg will be back next week. Yep, I have no comments in here. So I guess what I'm looking for right now will be news. The demand situation is pretty well known. The demand is anemic at best. What is going to change this market is a change in supply. I did see some news out of Europe about Russian sawmills getting closed down. It's going to take quite a while, I think, for that type of information to really affect the market. The main users of Russian timber are in Asia these days, for sure. You're looking at India and China. So I don't know that those are going to have immediate impacts, but we're going to keep looking at the news feed for any indication that North American production will slow down. But what we do know is demand is, like I said, anemic at best. It doesn't appear as though mortgage rates are going to moderate significantly in the near future. So I guess we're going to look forward, see what the supply side wants to do. All right, with that, Greg will be back with me next week and have all the charts that he normally has. We can go through them in a little more depth. Otherwise, if you have any questions, please reach out, and we'll talk to you next week.